Greetings everyone. This is King Solomon, and in today's video, we'll be looking into market fractality. Market fractality. It's something that everyone have probably heard of, and the concept is actually simple. Then that's what I'll be showing you guys in this video. And then one thing I would um be making sure, one thing I'm going to make sure to do in this video is after showing you guys the simple concept of how it works, I'm going to show you how you can make use of the fractality of the market, right? When it comes to taking trades, when it comes to analyzing, and I'm very sure that this is going to help you analyze efficiently and spot if you can put these things into practice, right? So let's dive into the video already, guys. From the very meaning of fractality when it comes to trading, fractality is known as the when something is embedded in another, right? So we're talking about a structure. Talking about fractality means what can this structure be split into, right? How can we get smaller structures from this structure? That's what market fractality is all about. And one thing that is very pleasing to hear, right, is that the market is made up of um fractal structures. And what differentiates these structures from one another is simply the time frame, right? This top icons you can see here from the 1 minute to the yearly time frame, all right? These are what actually gives us the splitting of the market structure. So from the very look of this first chart pattern I drew here, you can see that we had an up move here, right? Then we had a retracement. We had a retracement into this other block. This retracement can also be called an RTO, which means the return to other block, right? So thereafter the mitigation of this other block, what happened next? We had an impulse move, right, to take out this buy side liquidity. So this impulse move took out this buy side liquidity, and then this high was marked as a break of structure, simply because this um simply because this move caused the break of this former high, right? So that's a short thing that you guys already know. And when we now look into this, you can see that this same structure is what is happening here, right? And that's why I used the same color um to ensure you understanding how the structures are formed. So we have this black as the up move. You can see the black as the up move here, all right? We have this red line as the down move, that's as the retracement. Same thing happened here. And then finally the green line to represent the impulse move, and that's the same thing that is visible on this other side of the chart too, right? So what am I trying to derive from this structure that I drew here? This go up, retracement, and an impulse move is known as an uptrend, right? Why? Because we broke structure to the upside. It's known as an uptrend because we broke structure to the upside, and then we created a new low, which is regarded as what? As a higher low. Now, this low is regarded as a higher low. Why? Because this low is higher than the former low created, right? This was the former low. Price went up, retraced, price mitigated the value of the block around the year, right? And then broke through the upside, causing an impulse move. So this new low is the higher low now. And then we've now created a new higher high. Why? Because this high is also higher than the former high, right? This was the first low. This was the first high. Now this is what the second low, and this is the second high. So when it comes to the uptrend of the market, we do have series of higher highs and higher lows, right? Highs and higher lows. And when it comes to the downtrend, all right, that's when we have the lower highs and the lower lows, because the market is actually breaking through the downside, right? But now looking at this, you can see that I marked this as the HTF, right? That's the higher time frame. And then looking at this, I marked this as the LTF, which is the lower time frame, right? So this up move, down move, and up move is the same thing as the up move here, the down move here, and the up move here. So in this higher time frame structure, we can see that we have only one break of structure, right? Yes. But now looking into this LTF, we can now see that the market got fractal. The market got fractal, and that's seen by the market on the lower time frame breaking structures, all right, on the lower time frame, breaking structures on just one move that was created in the higher time frame. In this HTF here, this one line was just an impulse move, right? This one line was an impulse move. But then looking at this lower time frame structure, this was not just only an impulse move, this was as well an uptrend, right? I said it in the beginning of the video that an uptrend is known as the breaking of structures to the upside, where the market creates a series of higher highs and higher lows. So now, in this case, this is the same thing that is happening here. This impulse move on the higher time frame created an uptrend on the lower time frame. So on this lower time frame, you can now see different break of structures to the upside. All right. If I'm to start marking it out, you see me marking stuff like this, right? You see me marking stuff like this as break of structures, break of structures, break of structures, and so on and so forth, right? So it means this impulse move on the higher time frame is created an uptrend on the lower time frame, right? So it means on just this higher time frame move, you can take advantage of this long move on the lower time frame by what? By simply executing on the fractal structure, right? By simply executing on the lower time frame structure. So of course, when you have higher highs and higher lows, you know that you can simply enter from the thereafter of the RTU, that's after the return to order block, right? So you want to be sure that you can see things like this, right? So on the lower time frame, you'll see stuff like this, right? Sometimes it might use an FVG or a reclaim block. Let's say it uses an FVG in this case. Then I'm marking this as an FVG, right? Let's say in this case it used the order block. In this case it used the FVG, and in this third case, let's say it used the breaker block, the reclaimed block, right? So I'm going to put this as this, right? So what do you just do on this time frame? Looking from this time frame here, it's visible that people who actually want to take long trades, all right, from this other block would wait for this impulse move, then would need to wait for this retracement into the other block, right, before they can get triggered on this time frame. But now looking at this, you as someone who now understands the market fractality, you want to go down to lower time frame and look for how you can utilize this structure, right, and take meaningful trades from it by simply selecting your valid POIs in respects to the structure you're having and probably an inducement. So in this case, I'm seeing this as a break of structure, and then I'm like, okay, since price has broken structure here, we're probably going to be retracing, all right? So I looked at this and I probably saw the valid point of retrace here as an FVG. Then you can see that I would probably be taking my entry from here. From here, my SL would be slightly below here, and my TP will be at this side liquidity, all right? So this is something that I would have taken on the LTF, right? So just the impulse move on the higher time frame can give us a series of uptrend, right, on the lower time frame. So when it now comes to this point where the market started its retracement, right, the market said it's RTO, then you are sure going to have a change of character on the LTF, right? You're going to have a change of character on the LTF. You're going to see something as this. This being a what? Change of character. So when you see this, this gives you the confirmation that the impulse move is about to start, right? The impulse move is about to what? To start, and you probably want to see downtrends very soon, right? So on this, you can as well start leveraging on this idea. Now, it's not just the break of structure and the break of structure every time. There are times where you're going to have to check out for your liquidities, all right? In this case, let's say we have something like this. The valid POI might be here, right? This as your OB, and then these points might be a liquidity. Right? So someone who is trading on the higher time frame, swing trader who is trading on the higher time frame, expecting price to come into his order block, right? But you knowing that, okay, the downtrend has begun, right? I can still, even if you're the one trading that higher time frame and you're expecting price to come into your order block for your buy trigger, for your buy order to trigger, right? You can as well take the opportunities on the lower time frame by coming to the lower time frame, looking for the substructures formed, right? And then leveraging on it. So in this case, you're seeing this as your IDM, right? As an IDM, I assume this as the valid order block. So you probably want to take a trade from this zone here, right? You want to take a trade from this zone. You want to have something like this as well. Right? And then your TP will be where at the sell side liquidity. That's where price goes to before going to your entry, right? So this is something that you can make sure of. This is something that you can leverage upon, all right? So that's just the meaning of market fractality. The market structure splitting into different stages, right? Where one stage is embedded in the other, and that other is embedded in a higher time frame structure, right? So it's just like level by level, you opening this level, going down to another level, seeing another structure, seeing another structure, and all of that. So it just requires to have the basic understanding on this thing, and you are good to go, right? So of course, when price tapped into this higher time frame order block, you can see that for the impulse move to begin, all right, we now add a change of character, that's a bullish change of character around here to indicate that the impulse move is about to begin. All right. So there's something I'm going to say that later. All right. So now that this has triggered, this person here is actually going to want to pick a trade from this other block. Is just slightly below, and is target at this buy side liquidity, right? So this is something that the person is going to want to do, right? Is going to do rather. Of course, if you're taking this trade as well, you can as well leverage on the lower time frame by doing what? By taking confirmation trades, right? On the fractal structure, You know, wait for a change of character on this substructure, then you want to take advantage of it. Let's say this is also giving us an inducement. Do something like this. Once you can mark your structure and inducement, you are good to go, right? This was your IDM, and then your entry from the lower time frame order block, and your TP is supposed to be where at this buy side liquidity, at this substructural buy side liquidity, right? But then this is what most swingers do. They use confirmation entries on the LTF and use higher time frame targets. It means you want to use an higher time frame side liquidity as a target. So in this case, you are using this side by side liquidity as a target, right? You're using this buy side liquidity as a target and not just the substructural side liquidity here. So it means instead of using here, you want to use this as your target. So this is going to give you a greater risk to reward, right? It's going to give you a greater risk to reward. So this is simply if the explanation on market structure, all right, on market fractality rather. So it's just about you understanding how these structures are embedded in one another and how you can make effective use of them when it comes to analyzing the charts, right? Okay, I want to say something the other time. When you're trading against the trend, right? Let's say we're actually bullish and we're breaking through to the upside on the higher time frame. When you know that we're actually bullish, when it comes to the retracement moves that you're expecting, right? You need to be extra careful when taking substructural trades, such as this one, right? Because it's possible that you might not be correct with your valid zone, right? It might be the price wants to use another valid zone around here, right? You might not know, and you might be anticipating price to come into your own zone, while price might want to go with its own zone, right? So that might have you eat SL if you're not very careful. So what you want to do is either you prevent trading against the trend, or you try to mark out all the valid zones on this impulse um structure, right? On this impulse structure. Once you've done that, you can be sure that once price taps into any of them, you want to stay out of short trades for that moment. So that's all on market fractality. I want to see if I can see a chart example, right? Looking at EURUSD. Okay, on this daily time frame, right? What can you see? You can see a break of structure to the upside here. You can see a break of structure to the upside here, right? You can see another one here. And you can see that price actually came to use the strong low. That's the rejection block. That's the wick of this um big green candlestick. The wick of these candlesticks are known as rejection blocks, right? So what do you notice? You can see that price actually um from this high came down into this strong low, right? Came down to this valid zone. Since this is the valid zone, this low is the strong low, right? This is the strong low. And then thereafter, price made another impulse move to break this former high, right? To break this former high. So in this move, if we go down to the lower time frame, okay, and this is how you should move when it comes to market structure, right? You want to go from the probably the yearly time frame to the monthly time frame to the weekly time frame to the daily time frame to the 4 hours time frame to the 15 minutes time frame and to the 1 minute time frame. I'll come again from the yearly to the monthly to the weekly to the daily to the 4 hours to the 15 minutes and to the 1 minute time frame. That's how you can be able to clearly see how these structures are embedded in one another, right? So um from this daily time frame, we want to go to the 4 hours time frame, right? Now on this 4 hour time frame, what can we see? We can now see series of trends, right? On this impulse move, if you want to mark, you can mark moves as this. This was a very good pump, right? Went up here, we came down, right? Went up to this high, we came down. You can see this week, we came down here, went up to this high, right? We came down here, we broke this high, and then we came down to clear this low, meaning this low was an inducement. Do you get this low was an inducement? So price came to clear the low and then went up, back up towards to break the structure. After that, price came for the other block, right? Went up again, came down, went up again. This was another inducement low. Price came for an order block around here as well, right? Then went up to clear this high. So this were all break of strings to the upside. Now, when it was time for the retracement moves to start, right, you can see a clear dump, which caused a change of character, right? A bearish change of character, right? So thereafter, we can see the continuation of the downtrend. This was actually an inducement. Price came to use a valid zone around here, right? Took it out, then went down, came down to break the sell side liquidity, went down, came all the way here, all the way down here, and so on and so forth, right? So from here, you can see price coming all the way down here as well. Then what now happened? We had a huge change of character to the upside. We had this huge change of character to the upside around here, right? That's to tell you that since price has mitigated the valid zone we marked on the higher time frame, so we're sure to see a substructural change of character, right? A substructural change of character. And if we look at this, if we want to ask that, okay, how can we take trades from here? Looking at this, you can see the candlestick that caused the change of character. You can see this valid candlestick, right? It took a liquidity from the former candlestick, and it has FVG present in its formation. So you want to mark this out as your valid zone, right? And then looking at this closely, this looks like an inducement. This is an inducement. So you can mark that as an inducement and expect price to come into your zone, right? So this is on the substructure. You would have been taking trades on the substructure, even though you are on a swing trade, right? So this is how you would have taken this substructural trade with your TP at this substructural buy side liquidity, right? Giving you a 4-hour plus trade. But then if you now want to milk this market properly, you would now have to use the higher time frame buy side liquidity as your target. So I would want to draw my targets to this high, to the higher time frame former high, right? Giving me 6.5-hour trade. And this was how it went, right? So it's just about knowing how these structures are embedded in one another and making efficient use of them when it comes to analyzing the chart. So this will be the end of the video. Thank you for watching to the end. All right, see you guys in the next video.